is going to be a very engaging panel discussion now, and thankfully we have increased the ant in the room and the energy, which is what these speakers needed and the moderators needed. We have our moderators that I will be introducing first. I would like to call upon Mr. Faraz Mahmood, founding team member and business head at Centricity, with the 20+ years of experience in asset management and wealth management with top-tier AMCs, Fidelity, Bandhan, and ICICI Prudential. Please put your hands together for Faraz Mahmood. Welcome, Faraz. Introducing our next moderator for this panel, which is going to be Mr. Anirudh Mahanot, founding team member and business head Centricity with 20+ years of experience in private wealth management with marquee financial institutions such as Citibank, 360 OneWealth, and Julius Baer. Can we have a big round of applause for Anirudh, please? And we have some eminent personalities who will be gracing the stage as our speakers today, as the panelists for this panel discussion. Namely, the first one will be Mr. Vineet Sukumar, founder and CEO, Vivriti Capital and AMC. To tell you a little bit about Mr. Vineet. Vineet is a promoter, founder, CEO of Vivriti Asset Management Limited, incorporated in 2019. Vineet is also co-founder of Vivriti Group, founder in 2017, and comprises a debt platform UB along with an NBFC. Vineet has over 20+ years of experience in financial services as an industry expert on debt, capital markets, credit, and financial inclusion. He is an alumni of IIT Kharagpur and IIM Bangalore. Please put your hands together for Mr. Vineet Sukumar. Our next panelist, of course, no panel will be complete without a boss lady in the panel, Ms. Geetika Gupta, Fund Manager, PMS and AIF, ICICI, Prudential, AMC. Ms. Geetika, before please kindly step up on stage. To tell you a little bit about her, she's the Portfolio Management Services at ICICI Prudential AMC, where she joined in August 2021. Prior to joining ICICI Prudential, Geetika held senior positions at First Voyager Advisors and Kotak Institutional Equities in critical roles. Geetika started her career in 2007 at Lehman Brothers, covering US equities. She is an alumni of IIT Delhi and IIM Ahmedabad. Please put your hands together for Ms. Geetika Gupta. Our next panelist is Mr. Harshal Joshi, Fund Manager, Fixed Income, Bandhan AMC, who has been with Bandhan for the last 17 years and has also held a position as a principal at ICAP India Private Limited. Please put your hands together for Mr. Harshal Joshi. And of course, this panel discussion would not be complete without the man of the hour, Mr. Manu Awasthy, founder and CEO of Centricity WealthTech. I think that deserves a big round of applause. Welcome back, Mr. Manu. Before I leave the baton to the moderators, this panel discussion is on capital market outlook, navigating uncertain times, and this discussion is going to make them certain. All yours.
Good afternoon, everyone, once again. And the esteemed panel, thank you so much for being with us. And we are all looking forward to a lot of pearls here. Especially, let's start with the lady. And before that, just a few data points that I think we are all aware of. So, Geetika, the market, equity asset class, the most loved asset class at this point of time. Nifty has doubled, reached 24K in last 5 years. Sensex has reached where it has in last 5 years. Mid caps have given 3 to 5x returns on an average. Small caps have given even more. Now with that as the pretext and the context and where we are, what do you think about the current equity valuations, the current levels, whether these are sustainable, whether the new investor should be entering now, staggering it. What are your thoughts on this asset class at this point of time?
Thank you for the question. Before I start, I'll just like to congratulate the team Centricity. I was looking at the presentation and really impressed with what you guys have created in the last 2 years. So congratulations to the entire team. Very impressive. So yeah, so related, it's okay. So related to your question, I think you're right. Market has had a great returns in the last 2 years, 3 years. But broadly, what we at iProof follow is earnings growth. Our core belief is that any stock price is a function of basically earnings growth and the multiples. The good thing that we are seeing in the Indian market is that there is a very broad-based earnings growth. If the just to give you an example, if we look at the last peak of the market, which was October 2021, since then Nifty is up about 30%, but the earnings growth for Nifty is actually up almost 60%. Now again, if I look at small cap, there also, while the small cap index might have gone up by almost 75%, almost by 60%, but the earnings have actually been similar and they've grown at 70%. So given the fact that the movement that we've seen in stocks, it's driven by earnings, we believe it's healthy. If it was only driven by excess liquidity, chasing returns and multiples going up without the support of earnings, something which we saw in the 2017-2018 cycle, that would have been really scary. So broadly, we are okay with how the market is trending. Having said that, there are definitely, we can't paint the entire market with the same brush. There are pockets of exuberance, as well as there are pockets where there is still opportunity in terms of putting money in the market. And that is, I think, the work that we do at iPro in terms of trying and ensuring that those buckets are not in our customers' portfolio where, the valuations could be at risk. So broadly, we are seeing pockets of opportunities still in the market where we think from a 2 years, 3 years time frame, we can still invest our customers' money. We typically don't take short-term calls. So if you ask me next 3 months what's going to happen or 6 months, I definitely don't have an answer. But if you ask me if you have money for 2 years, 3 years, I think there are enough opportunities still where one can remain invested. Yeah.
So Geetika, my next question to you is, we have seen a very important event just got over, which was the general elections. And the result was slightly not what was expected generally. So now there is another big event which is on the blocks, which is the budget. And there'll be plenty of more events which will be happening in the next 3 to 6 months. So which all events do you think which will be impacting the markets? And any take or any Aktung baby kind of moment or concept which we should keep that in mind?
I think I said that if you ask me what's going to happen in the next 3 months, I really don't have an answer. Because in the short term, there's a lot of sentiments which drive the market, right? You've only spoken about India. What about US, which is also going into election, right? The interest rate trajectory in US could be a bigger driver of what's happening in the market. So I think there are always several macro factors which are impacting sentiment. If one stays focused on bottoms-up earnings growth, which is what our core investment philosophy is, that you can still remain on the side of caution and make good returns. Having said that, to your question on election, I think while the majority is not as much as expected, but still the good part is that BJP government has come to power. We'll see how, what is the change in, policies. So far, at least the development agenda of the government seems like it's on track. There could be some change in strategy in terms of maybe populist measures, which again is speculation. So we can't play on that, right? So we'll see as it goes, but there are definitely, enough stories on manufacturing and capex, which is what the core agenda of the previous, of what BJP did in the previous, when they had the mandate. I think that will still continue.
So again, ICICI, the PMS strategies, I guess, in the last 3-4 years have been going through a dream run kind of a situation where most of your products are doing great. So any adjustment and strategies or any tips you would want to give to our audience? When I say tips, I mean not the stock tips, but things to keep in mind and bear in mind while trying to create an equity portfolio at this juncture.
Yeah, so no, we've had a good return, but I think a couple of core beliefs that we operate by, and the portfolio is always changing. While we are investing from a long-term perspective, there'll be some pockets, as you were asking me earlier, there'll be pockets where the valuations have run up too much and maybe we decide to take some money off. And at the same time, there are several themes, for example, in consumption, for example, is one space which has under-delivered in the last 3 years. So portfolio keeps changing. But I think a couple of core beliefs that we have, one is that volatility is inherent in the market. One needs to be really invested for a long period of time to make money in the market. So, beginning of last year as well, when we started 2023, there was, talks of US recession. There were a couple of US banks which went belly up. And people thought that, equities will not make money. But, the kind of returns the market delivered last year. So don't try and time the market. One really needs to invest from a long-term orientation and stay invested for a longer period of time. And second core belief that we have, it is that one needs to follow earnings growth. And it is pockets of market and companies which create wealth. So that is how, we remain focused, within our PMS and AIF schemes.
Okay. Thanks, Geetika. That was very insightful. Let's switch gears and get into fixed income and debt as an asset class, straight jumping from highest performing equity funds and PMS to debt. So Harshal, here's the, the curveball or the googly to you, because the biggest challenge that our FPD partners and IFA friends are facing today is when equity has been doing so well, and it's difficult to convince clients on those 7 to 10% kind of debt returns. How do you see our IFA and FPD partners placing debt mutual funds in the portfolio? And knowing that, we are at almost at the peak of interest rate cycle, if we are, that again, if, your insights would be very helpful. What would be the right strategy to play it? We know that there's a duration play. We know there's an accrual play. So what would be the right placement in the portfolio, and how our FPD partners can enhance returns for their clients in this asset class?
From interest rate cycle, I'll take that first. We firmly believe not only domestic, but global interest rate cycles have already peaked. It's just a matter of time, where central banks like Fed, ECB especially, is going to react on the interest rate on the cutting cycle. We have seen major economies like Switzerland already cut twice. We have seen what Japan is doing, to support their economy. We are seeing what China is doing to support their economy. So broadly speaking, it's kind of pretty visible where the global growth, eventually is heading. It peaked 2 years back, and it has been slowly slowing down in, zones like Europe, especially, as we spoke about Switzerland. That particular zone is showing slowdown. It's just a matter of time, when US eventually realizes their growth is faltering. And direction of rates incrementally from here till maybe next 6 to 18 months is pretty much predefined. It's just the speed of the rate that is the problem. So in last 2 years, market would have anticipated US to cut by 200 basis points. And today there are, foreign bankers, economists who are predicting US to cut by only 75. And that is, got to do with how their inflation has moved versus the actual, their expectation versus the way actually inflation has moved vis-a-vis the growth. But as you rightly said, the interest rates have peaked. Second of all, I would love to have some euphoria in fixed income actually. The way equity has been doing, similar structural changes at India domestic level, we have been observing. And one of the stamp that we, at Bandhan also, we do a lot of macro research. One of the stamp of India's structural story on the fixed income side was when JP Morgan included, India as a part of their index. And it had never happened before. And just to give a very brief idea what it means to India is the total anticipated FPI flow from the index of JP Morgan as well as the Bloomberg is close to $30 billion. And
Sorry, how much?
$30 billion.
$30 billion. Okay.
And that kind of money in fixed income we have never seen. It has never happened in India. So I have no chart to show you that what yield are going to react to if $30 billion comes in, because I have no idea. That has never happened in India. And the scale of it is massive. Just to give again an anecdotal example, India's gross borrowing for this year is 14 lakh crores. And the anticipated total 30 billion flows, around 6.5 billion has already received in the calendar year. Market is anticipating another 25 to 30 billion total flows in this financial year. So we are talking about close to 25-30 billion dollars on the base of 14 lakh crores, which is roughly around 2.5 to 3 lakh crores on the base of 14 lakh crores is massive. The market continues to underappreciate it because obviously there is some, in India we have a history to play in that very small range. But according to us at Bandhan, we firmly believe it's a structural story. It's not about that last 10, 15 basis point movement. It's not about, whether we want to capture before the policy or after the policy. I mean, people sitting in the room will understand the questions that investors ask. It's more to do with if government is a balance sheet, if government is a corporate, Indian government has reasonably done well in last 3 to 4 years, be it fiscal, be it maintaining inflation, managing inflation, and definitely growth. We continue with the fastest growing economy. We are heading in the right direction. So conceptually, if India is a corporate, that corporate should start borrowing at a lower cost because that balance sheet has done really well. So far, we have not seen it. Directionally, we have seen, anecdotally, we have seen maybe 25-30 basis point movement on the yield curve. But we continue to believe this is a structural story because if you talk about the current account deficit, if you talk about fiscal, if you talk about inflation growth balance, everything shouts out that the movement on the yield should have been much more significant, and that movement is here to stay. And that is why we are very confident on market. We are running one of the highest maturities in the product like Gilt and Dynamic, which we have never run in past. At least in my working here in Bandhan, 14-15 years. We have never run dynamic bond fund at 30 years maturity. So that is where our confidence is. We are putting money where our mouth is. The question that you asked, how to answer that, it's a cliche. I mean, I don't want to use the term of asset allocation because everybody in the room knows that better than me. I would kind of say it's a premium you pay for safety. So obviously equity is doing well. You have large cap getting you 15%, small caps giving you anywhere between 20 to 35%. Somewhere down the line, when everything is going good, you have to look back and see, something if eventually goes wrong, then you don't have everything in your one, kind of every egg in one basket. And that is a premium you will end up paying because in fixed income, as you rightly pointed, it's going to be a range-bound, kind of a return because obviously the nature of the product is like that. But as a concept of fixed income, one needs to have not only try to time that fixed income, when RBI is going to cut, do you expect rate cut in the next policy? Do you expect, what is the total rate cut are expected? But it is what percentage of your total investment is in fixed income. And one needs to, especially now when equity closes every day at all-time high, one needs to be aware of what percentage of your total investment is part of fixed income. Then within fixed income, then you can select whether you want to go for, an interest rate oriented kind of a strategy, which is like a dynamic bond fund or a gilt fund, or you want to, go for more towards a core strategy, which is like a short-term kind of a category. But definitely one red flag, not red flag actually, is just an advice. When you invest into fixed income as a part of hedge or as a part of diversification, when your equity markets don't do well, the portfolio of fixed income should actually do well. So just one line I would say, when people have been chasing carry, and we have seen that in 2020, what happened to the mutual fund industry who chased carry. When you are chasing carry, and if your portfolio exists of a lot of credit-oriented strategies, if the equity market does not do well, that credit strategy will not do well because remember, those are the same corporates. Those are the same balance sheets. So if balance sheet is getting affected by the equity capital market, it is going to definitely have the same effect on the fixed income.
Harshal, here I will have to just interject.
Yes.
अगर आप समझा सकें कि आप what do you mean by carry, what the concept जो आप अभी बात कर रहे हैं, how does it work and how does it impact an investor?
So it's just very plain and simple. I'll give you an example. There is one bank, let's assume a PSU bank, who is giving you 7.5 FD, and there is a bank who is giving you 10.5 FD rate. Obviously 10.5 is a higher FD rate, but everybody in the room understands that if somebody is ready to give you higher rate, it means that either he is not able to receive the lower rate available in the market, or obviously there are risks associated to it. When I use the term carry versus the interest rate play, What I meant is you should, not only chase the YTM as a part of the fixed income pool, because it has to naturally be the hedge to the equity. So when equity market, and we all have very fresh memory of COVID, when equity market collapsed by 30, 40, 50%, if your fixed income portfolio gave negative return, then you have not hedged. So somewhere, on those lines, you can, prepare your clients, especially when it is all-time high. That is, in fact, the perfect time to start diversifying. And, a lot of people are very happy with the equity market. It's a brilliant time to be, euphoric about the fixed income.
So, Harshit, I think so this is the opportune time where Vineet needs to come into the picture, because you have given some insights on the duration part. So I have a few related questions, but I think so we would like to hear from Vineet. And all of you know that Vineet is the founder at Vivriti. They manage close to around 4,500 crores of AUM. They are giving a yield of anything between 12 to 14% to their clients. And they have already returned around 1,500 crores of money back to their clients. So with this great track record, I think so, Abhi Harshit pointed out something about the accrual strategy. So if we can have your views, Vineet, I think so it is a very, very opportune moment to hear from you.
Thank you. And unfortunately, my world is a relatively less exciting world than my two colleagues on the dais. We live in a very boring world. We do simple lending to mid corporates, and we try to build a strategy where people can get fairly long-term, 5-year, stable fixed income returns consistently every quarter into their bank account, right? Now, this market has become quite interesting in the last 5 years, because it is fundamentally riding on a belief that while the top 200 corporates in the country, right, predominantly contributing to both equity and debt strategies, right, are heavily traded. But there is a base of more than 4,000 companies below the top 200, which are becoming extremely interesting because the growth opportunity there is fantastic. These companies are becoming mainstream. They are becoming better governed. There is data that can tell us a lot about how they are doing, how they're running their business, how do we assess their numbers. And finally, the promoters of these companies are getting ambitious. So they want to borrow to grow. And that's the story that today we are riding on, which makes it a very interesting asset class for you to consider. Not correlated with fixed income, not correlated with equity, very, very stable quarterly returns. So whether the market goes up, goes down, you should be able to sleep, wake up, and see 13% in your account every quarter. That's the business we represent. It is a very relatively less exciting business, but it is deliberately meant to be so.
So Vineet, if you can please help us understand, the entire audience, what is performing credit? The structured credit and the performing credit that you're talking about, that you're playing in. I won't say playing in, I'm structuring your portfolio in. And how our advisors can place this in the portfolio, and where?
Yeah, great question. Now, performing credit, the way we define it, is lending to operating companies typically for long-term working capital and growth. So imagine a company, I'm going to give you a real example. Then imagine a company which is a trucking company, right? This trucking company transports windmills from South Tamil Nadu to Bangalore, but on a very long haul truck that can travel at 20 kilometers per hour and only travel at night. This truck takes 6 months to go from point A to point B. This company therefore will receive money 6 months and then a receivable period of 3 months later. So that 9 months gap has to be bridged by somebody's money, because the company has spent but not earned, right? And that's where a solution like ours comes in, saying that let me pay for at least 3-4 cycles of that 9 months, give the company 3-year, 4-year money, which can allow them to run their cycle and earn their money over a longer cycle, but still pay the bills, pay their team, buy new trucks, right? Invest in
Vineet,
capital
I'm
expenditure.
sorry, I'll just interrupt you over here. So we have many people from my side of the world, and they want to hear in simple language, which is English. So if you can just use a bit of English, I think
Why
so
not?
that the
Bilkul.
impact will be much better.
Bilkul. अब इस तरह की कंपनीज में क्या होता है कि when we enter these companies, they want money which can align with their growth, right? तो उनकी जो growth है, that is typically 15-20% annually, right? They want money which can be stable, where they don't mind paying the money as they earn, right? This is classic performing credit. Companies of 1,000 crore, 2,000 crore revenue, right? 1,000-2,000 crore के revenue है, 20% EBITDA margins, 15-20% EBITDA margins, profitable, probably in a tier 2 location. This example of a company is in a city called Namakkal in South Tamil Nadu, right? Very difficult for any of us in this room to envision that this company is 40 years old, 1,200 crores top line, grown through promoter equity for so many years. एक lender है, Axis Bank, सिर्फ एक lender है, right? So these are the kind of hidden jewels we find across the country where we are able to give them money, and this company is going nowhere, कहीं नहीं जा रहा है.
तो विनीत, ये these companies, why do they borrow at 15 to 20% from you? Isn't that very high? You know, the optically जब भी कोई सोचता है कि यार अगर कंपनी 15-20% पे बोरो कर रही है, इसका मतलब they can go belly up, there could be a lot of problems in the balance sheet, business में problem हो सकता है, payback में problem हो सकता है. The most important question, is it safe?
Let me answer that with some data, right? अगर 15 से ऊपर है, I will agree with you. Most of what we do is between 14 to 16%, 14 से 16 के बीच में. A good company has a return on capital employed, which is profits divided by the capital of 18 से 24% के बीच में. So 18 से 24% के बीच में कंपनी बना रही है. अगर कंपनी 18 से 24 बना रही है, तो 15 से 16 के ऊपर नहीं दे सकती. तो अगर आप देख रहे हो कि कोई भी फंड मैनेजर 18 के ऊपर रिटर्न बना रहा है, तो वो पैसा कंपनी में नहीं जा रहा है, या कंपनी में कोई सिचुएशन है, या पैसा कंपनी के बाहर जा रहा है, राइट? 95% ऑफ आवर वर्क इज 14 to 16%, 14 से 16. अब 14 से 16 के बीच में देर आर रफली 4 to 5,000 कंपनीज इन इंडिया विच विल फॉल इन दैट ब्रैकेट, राइट? करीब 300 से 3,000 रेवेन्यू के बीच में 15 से 20% मार्जिन बना रहे हैं, राइट? Across the country, across sectors, engineering, manufacturing, automotive, etc., etc. Now, your other question was, where does this fit in portfolios, right? And my answer is very simple. This is the portfolio which you want to realize regular income. This is the regular income portfolio. This is not the appreciating portfolio. This is a portfolio where you want every quarter or every month X amount of money to hit your account. So if you want to set some money aside, 1 crore, 3 crores, 5 crores, 10 crores, for a period of 3 years to 5 years, earn very regular returns every quarter, that's where this counts.
So, Manu, I'll request your intervention now, because you have been a seasoned private banker, having 22 years of experience, plus experience. You've dealt with all sort of clients. So be it HNI, ultra HNI, family office, corporates. So what does the situation which we are facing right now augment for us? And how do you think shaping up going forward between asset classes and what our strategy should be of deploying money?
I think so. This is the most difficult question to answer, because there is no right or a wrong answer for this question. Let me answer this question not from a lens of an expert or from a situation or a position of an expert, but more from a position which me and you both are together, that we have clients to manage. And we heard all the three people talking about equity, debt, credit. What it leaves me as a wealth manager to my clients to really pick, choose, and execute. Because ultimate responsibility that that comes is to us to decide what is it that is right for the client. Because I heard everyone, so I will try to connect the dots for each one of you. The way I would go about working around with my clients, given I have an option of doing debt, given an option I have to do equity, given an option that I can do credit play. And I'll try to be as simple and as basic so that I can possibly help you understand what I'm trying to say. The first point I will make is that, do we have a number around that out of the total investable money surplus, whatever we call in the Indian market, what percentage of that is equity? अगर मार्केट में 100 रुपए है, तो 100 रुपए में 2 रुपए, 5 रुपए, 50 रुपए, 80 रुपए, कितने रुपए जो है equity का है allocation? Any number that comes to mind? So, 10%. 10%. 4. Roughly around that, 5, 6, 7% is the number. So first of all, let's understand one thing very clearly. The most loved asset class when the markets are good, and the most hated asset class when the markets are in a sideways movement or a long-term sideways, is only 6 to 7% of the money. And this you can figure out. You go back to your clients who have equity portfolio, ask them how much money you have in PPF, bank deposits and other things. They will tell you how much money they have. And you will get a fair understanding of the number that you are managing or I am managing on equity vis-a-vis how much they have in debt. Now, let me build a very fundamental threshold for debt. Very fundamental threshold to think about debt as a category. इस दुनिया से जो है, अगर ब्याज हटा दिया जाए कि ब्याज में पैसा नहीं मिल सकता, कितने बिजनेसेस चलेंगे, कितने कोलैप्स हो जाएंगे? अगर हम डेट एज एन एसेट क्लास ही खत्म कर दें कि कोई ब्याज में किसी को पैसा ही नहीं देगा, बैंक छोड़ दीजिए, कितने बिजनेसेस चलेंगे? I think so all of us have an answer. I mean, so debt and equity go hand in hand. But the ultimate outcome of debt is equity only. एक आदमी बोरो करता है पैसा, एक कंपनी बोरो करती है पैसा, वो पैसा जो है वो लेती है, उसको बिजनेस में डालती है, चाहे वो 6% हो, चाहे वो GSEC हो, चाहे वो क्रेडिट प्ले हो, कुछ भी आप ले लीजिए उसमें. Anything that you want to take, you take that. The money goes into a business, that business prospers and it translates into higher equity value. And then you invest into equity. So I second his point that if equity is going wrong, that probability of debt going wrong is there. And equally important is that if the company is defaulting on debt, probably there will be a challenge on the equity. And what we have seen in 2018-19 with all the AAA rated companies going bad, their equity also, they completely came down. I mean, there was no stop in between. So with that kind of a situation, which is a catch-22 kind of a situation or a chicken or egg situation, what comes first? What do we do? What is the solution out of that? Okay. If I were to today look at it, I will look at it from a very clean lens. बहुत simple. The good thing about me and my team is that we are not the most intelligent people on earth. We are very basic, fundamental. We look at things with the very simplistic outlook. The weighted average return of the index since inception has been roughly around 13-14%. That's what we look at on a compounded basis. Why should I not look at a credit at a 12 to 14% with lot of, and not that equity markets have not corrected. I mean, just because of last 2-3 years of bull run, let's not forget equity markets do correct and do correct sharply. 2008 we have seen, post that we have seen. I mean, we have enough and more in our memory that we all have gone through. It corrects. Why is it that we cannot be really comfortable with something with lesser volatility at a 13%, if my portfolio can compound at 12, 13, taxation I'm for the moment keeping aside, if I can compound at 11, 12% with reasonable amount of certainty, surety, what is wrong with that? I'm just saying, it's a question which I am not saying do it or don't do it. What is wrong with in doing that? That's point number one. Point number two, all our clients, ultra HNI to retail clients, everybody has financial goals to meet. And unfortunately, there is one reality that not all goals can be met by one single asset class, which is equity. Long-term goals, yes, to a very large extent, but not all goals are long-term goals. Goals may vary from 6 months to 12 months to 18 months to 36 months. Up to 36 months, any goal which we are trying to meet through equity as an asset class is very, very risky, I would say, or the degree of uncertainty will be very high. And the only risk with equity is that it can be doing great for 20, or let's say out of 36 months, it can be doing great for 35 months. But the time you need the money for any event, if the market corrects by 20%, your goal is not going to be met. So, at the end of the day, whether it is AAA or going to credit, if I were you in a situation, I would very practically pick either of the offered credit play, which means that this particular credit, whether it is AAA, AA, unrated, whatever we call it, and even equity, depending upon the factors which will govern the client satisfaction at the end, that is his fresh income, disposable incomes, side income, his emergency cash which everyone keeps in, and would like to really pick and choose and put everything in order of his requirement so that he meets his goal or he or she meets his goal in the most effective manner, rather than really dwelling into whether equity is going to continue the bull run for next 10 years, or defense as a sector is great, or manufacturing as a sector is great. This is because as a whole, we are managing a much smaller pool in equity vis-a-vis what is it in debt, and there are different goals for different timelines. I would rather focus on meeting the goals with the right combination of asset class and products, rather than really pulling myself completely with a thesis or a synopsis, because if anybody could have predicted the equity markets, believe me, he would not have done anything in life but except investing in the right strategies. Because one last point, and why, just to explain why I am saying this, because in equity markets, there will always be two kind of events. The unknown known events, which is like election results or budget. These are the known events, but you don't know what the outcome of those events would be. And the second will be unknown. Events like COVID, which was unknown. And what was the outcome of that? I am repeatedly right now talking to all of you whenever I meet in different cohorts and different things. Don't get overswayed. Because when things will look the best, that is the time the most awkward surprise will spring. And when things will look the worst, then the most pleasant surprises will also spring in. So let's have a very balanced outlook. Let's have a very rational outlook. Let's not categorize asset classes and categories as good or bad. Everything works. If things would not have worked, believe me, they would not have existed in the ecosystem.
Manu bhai, wonderful point. Now, generally, हम लोग जो अपने partners से बात करते हैं, जो आपने अभी exact point you want to make is, अगर हम लोग को, if we are getting that 15-20% from equity, हम क्यों debt को देखें? So now I would like to put this question to Geetika, being a equity fund manager herself. What is your take on asset allocation, and how do you maneuver this thing through your own asset allocation?
I think, hello? Yeah. I think asset allocation is very, very important. Uh, I mean, we actually did some study some time back, and uh, depending on the financial goals, as Manu was talking, the financial goals almost 80-90% are actually achieved by the right asset allocation. And it is also more important because no two individuals are alike, right? No two financial goals are alike. Everybody has a different income profile, different needs. Some people will have short-term needs, some people will have long-term needs, right? So uh, as you know, if somebody particularly has short-term needs and financial goals, then equity is definitely something which can be very volatile. It is only for money which you can spare from a long period of time. So at the end of the day, I think the work of you guys, the asset allocators, is much more risky, much more difficult as compared to us, because when the person comes to us, the asset allocation is already done. The person has already decided whether he wants to put 20% or 80% of his money into equity, and we just give him the best solution from our end. Definitely asset allocation is important, but I am not the expert. It is for you guys, and each solution is different.
So, don't we all want to know the stalwarts here? How do they invest their money? And what is their asset allocation? Let's put them on the spot. Should we? Great. So let's start with Vineet. Vineet, what's your asset allocation as of today, and how do you go about investing and building your own portfolio?
You won't like my answer. 100% of my money is in Vivriti Capital.
Wow. Okay. Skin in the game, guys.
But I'm going to use this opportunity. Private equity. Private equity. But I'm going to use this opportunity to make a pitch for credit, right? That Manu mentioned the unknown and the events that led to COVID and what happened in COVID. So we invested we raised family office money of 1,300 crores between March 2020 and March 2021. We just returned all of it in the last 6 months with outperformance of hurdles of 40 basis points. So that just tells you that in a very wide number of scenarios, credit, if handled well, can actually perform very well, hence performing credit.
Great. Geetika, how about you? Do you invest outside ICICI as well? When I say ICICI, as in ICICI funds and ICICI PMS, do you?
Yeah, of
And
course.
what would be your asset allocation as of now?
So as of now, as in I just have like one mortgage, and X of that, everything else I put it in equity.
So basically 100% equity at this point of time.
Yeah, and some debt, little. Yeah.
So guys, again, skin in the game, money where the mouth is. Harshal, how about you?
So mine will be 40 equity, 40 debt, and 20% gold because I have wife and mom to please. So that is 20% is the compulsory part. Other I've like split 50-50 because I don't understand equity and debt does not give more than 10. So yeah.
But Harshal, all the moms and the wives and the home ministers
Yeah.
have been beating us black and blue by generating those 12 to 13% annualized returns on sovereign gold bond.
Definitely. So I think they are always more excited at the bonus time more than me because that is when I buy gold every year. So yeah.
Right.
So yeah.
How do you go about your equity investment? Because you're a pro when it comes
So
to fixed income, but आप अपना equity investments कैसे करते हैं?
See, unfortunately, I come from mutual funds, and there are regulations which does not allow me to do anything but mutual funds. So even PMS, there are so many regulations are in place where I practically cannot invest into PMS because there are periodic disclosures which we, as an investor, as a fund manager, I have to give. So the only way I can invest is via mutual funds, and since I'm into service industry, every year when the bonuses are around, one portion goes chunky, and 80-90% of my equity investment goes as SIBs.
Right.
So, Vineet, here I would actually like to say something. Credit is one space that is not understood by many. So again, बहुत ही simple भाषा में, बहुत ही साधारण लफ्ज़ों में, अगर कुछ आप 2-3 हार्ड हिटिंग पॉइंट्स बता सके ताकि हमारे यहाँ बैठे हुए जितने भी पार्टनर्स हैं, they also understand the power of accrual strategy and the power of understanding I would say calculated risk as far as credit is concerned and how to cover that risk. And what are things which you have done at your company to cover these risks which might just happen in due course of time?
Thanks. Let's try and simplify. Uh, all the three on this table are speaking of portfolios. Because with portfolio comes diversification. With diversification, you are able to mitigate, reduce risk. Risk reduces because अगर कोई एक bet अच्छा नहीं चल रहा होगा, but you can still manage. In credit, that is very true. For example, a typical performing credit fund should not have more than 5% concentration. So 100 रुपए का अगर फंड है तो 5 रुपए से ज़्यादा किसी एक कंपनी में इन्वेस्ट नहीं करना चाहिए. क्यों? क्योंकि 5 साल में the fund will make approximately, the 100 becomes roughly 160. अब 160 में से अगर आप समझ लीजिए 2 कंपनियां खराब हो गई, like डिफॉल्ट हो गई, right? The 160 comes down to roughly approximately 130, 135, which still means that over a 5-year period, you have beaten inflation, right? And you have got full capital back, right? So concentration is the single biggest concern to kind of diversify away from in a performing credit fund. This is point one. The second is lend to operating companies. ये promoter finance, startup finance, ये सब जो real estate, ये जो categories हैं, typically that money doesn't go into the company, it goes outside the company, right? Those are much riskier strategies versus performing credit, where money company के पास जा रही है, company के growth के लिए जा रही है, right? I think if we stick to these two fundamentals and all your partners in the room, when they assess कि ये fund कर क्या रही है, पैसा कहाँ जा रहा है, right? कितने कंपनियों को जा रहा है, I think if these two are kept note of, you will make lesser mistakes.
I actually have a question, if I'm allowed to ask. So if there's a corporate who is borrowing at 12%, should I buy equity of that corporate or should I buy debt of that corporate, and which is safer? Which is safer?
So the question is, I think for everyone's clarity, if a corporate is borrowing at 12%, should I be buying their equity or should I be going for the credit?
Safer.
And which is safer?
To contextualize, a company borrowing at 12% is likely to be BBB plus या A minus rating, which means very likely या company SME IPO exchange पे है या listed नहीं है, right? अब I don't think that my feeling is that I'm not an expert, but I don't think the SME IPO exchanges offer the kind of liquidity that the main bourse does. Now, which leaves private equity. Private equity today is a very, very difficult asset class for mid-corporates. It is a very good asset class for NBFC equity, but outside NBFC, private equity is very difficult because monetization and the kind of IPO interest that you see takes a long time to happen. So at 12%, stick to debt.
So Vineet, another question related to that. Any exclusions or negative list for your portfolio? Let me just explain. ऐसा कोई company है या sector है which you completely avoid taking in the portfolio?
Two examples, two themes. We are a great believer in India. We think India is outperforming versus the world. We don't want export-oriented companies.
You don't want export-oriented
companies. So 99% of what we do is companies that sell within India, for India demand, for India consumption, for India B2B.
But now extending this, export में क्या खराबी है? Why not see if it's a Indian manufacturing company exporting it to the world. What's wrong with that?
Because the market they're exporting to is slowing down. For example, if you are an exporter to Middle East and you're exporting, we encountered a company which exports fruits to bananas to Middle East. They are not in great shape. They are now moving to domestic sales. We have a company that exports tiles, right? Floor tiles. Morbi ki company hai, to Europe. The market has slowed down so much. They were 90% export, 10% domestic. In 3 years, they are moving to 50% domestic. Because Europe is not buying tiles. Construction activity has slowed down, right? There is a war. There is a tightening that is happening. So the market for tiles has slowed down. Imagine tiles, a commodity. You think tiles will sell everywhere, right? Hence, we are staying away. So bananas and tiles are the most commoditized products you can think about, right? But even in these cases, the export markets are slowing down. Companies are moving back to India.
What about real estate? Is that a negative sector for you in credit space?
Great question. To be very candid, हमने ज़्यादा काम किया नहीं real estate में. Having said that, recent markets are reasonably positive, right? हमने ज़्यादा काम किया नहीं है for a very different reason, because we see very, very severe corporate governance challenge. Because हमें लगता है कि रेरा आने के बाद बहुत बदल गया है, बहुत नहीं बदला है. अभी भी we see examples of the RERA account being diluted, etc. So we are quite concerned with the level of corporate governance, except the top, say, 10, 15, 20 players, it's very difficult to get comfortable.
So, Harshal, again, thoda sa aapse janna chahenge from a retail perspective or a HNI perspective, what part of the yield curve is looking attractive to you? So whether we should go long or short or medium, or we should follow the fill it, shut it, forget it philosophy of dynamic bond funds?
If you have very specified goals, since we are discussing about goals, if you have time-based specified goals, then my general recommendation always is that horizon of your investment should match the maturity of your investment, as in case of fixed income. If you have fill it, shut it, forget it, given the macro story that we are in, and even I am a big believer of India story, you know, I have never, at least in last 20 years, we have not seen macros which are at each aspect which are so comfortable. So there will be always one portion of your investment which is fill it, you know, shut it, forget it. That you can aim at the longer end. It could be a dynamic bond fund, it could be a gilt fund, it could be a long duration fund. But if you have goal oriented, if you want to buy a house after 3 years, you want to go for a trip after 2 years, then, you know, if it is goal oriented, then thanks to SEBI, they have categorized it. So you have 1 year products, you have 2 year products, you have 3 to 4, 5 years product. Generally, from retail perspective, a short-term kind of a strategy from a medium-term perspective makes sense, because again, in India, people are not a permanent fixed income investor. They have a motive behind a fixed income investment, but there will be X percentage which is a permanent, and that should focus towards dynamic and gilt. The remaining 70% of your total fixed income investment can continue to in the short-term space.
Thank you so much for that. So again, it was a great kind of a discussion we had. So I guess Anirudh has something to say, but if we can have the closing last few points from each one of you, that will be great after Anirudh's question.
Yeah, Faraz, I wanted to open the floor for Q&A. Probably next 3 to 4 minutes, we can take some questions which you may have for the panel here.
See, when equity will correct, no one knows. But you want to get your asset allocation correct. And there are different types of hybrids, aggressive hybrids, and you will not miss the bus of equity rally. At the same time, you will participate in debt. And how much of asset allocation you should have in hybrid so that you don't miss the bus on either equity side or on the debt side.
See, hybrid as a product is, especially now, is kind of a brainchild of taxation benefit, to be honest. So if I am a fund manager, I am from debt, she is from equity. From your perspective, you are the fund manager for your client. If you can identify good equity products and good debt products and create a hybrid for them, that, according to me, makes more sense rather than investing into an existing hybrid product, Because it's as good as saying, somebody can say, I like tomato in sandwiches, but I don't like tomato in pizza. But from your perspective, if you can create, do your due diligence, select better quality equity, select better quality defined debt. Because in hybrid, what happens is you don't control maturities, you don't control quality of credit. Versus what SEBI has done, especially with the mutual fund debt now, is they have defined this PRC matrix. So within PRC matrix, you can select schemes based on credit quality. You can select schemes based on the maturity of the schemes. So at all points in time, you know that what your expectation from the debt is. At all points in time, if you select equity also right, you know what your expectation from equity is. So what a fund manager in debt scheme does to the debt scheme, you do be the fund manager for your investor and select the right equity and right debt and create a artificial hybrid for them so that you have better control on the schemes that you have invested. Also on the quality, especially on the debt side, because that is the most important thing, on the credit quality of the portfolio, you can control better based on the PRC matrices are there.
My name is Dinesh, and my question is primarily because of this product called SWP. Everybody talk about SIP. Rather, I go and meet my clients, and after explaining all the things about mutual fund, he says, I don't want to invest into mutual fund, but I want to invest into SIP. So, similar way, SWP is a new product which is of a great importance for people who are just retired or want to live a very good retired life. So my question is that in case a person is withdrawing around 3% to 7% on a yearly basis, so why shouldn't I give him equity products, maybe a combination of large and mid cap, and maybe a thematic fund or maybe something like that, which could give him a constant income on a monthly basis and also appreciate his income, the amount invested, the appreciation amount is going to be better than what is going to be there in maybe if he buys a property or maybe puts into an FD or something like that. So how good is having a combination of different equity products for a SWP? This is my question basically. Yeah, people who have just retired or want to leave a retire and do not want to invest into property and get stuck out there, or maybe have a low return by investing into an FD or something like that maybe.
This is a very interesting question to me. Solved this kind of problem multiple times and have seen the outcomes also last 22 years. First of all, to me, the biggest sin to do is to mark any kind of a cash flow against equity. Equity is not a cash flow product. It's a compounding growth product. So anything which we are trying to plan out and we are saying that equity से पैसा आएगा और इससे आपका घर चलेगा, ये 3 या 4% वाला जो आपको या 3 से 7% जो cash flow चाहिए, I don't think so. It just works. It can work incidentally. It can work when people are lucky. It can work when the markets are good. But when we make such kind of a plan, there has to be high level of certainty about the execution of this plan. There are two parts to this kind of a situation that you are in. Part one is cash flow, part two is growth. So let's just divide the cash flow and the growth part into two. The moment you try to achieve both with the single strategy, which is equity or something really hybrid, either you will go right on both or you will go wrong most likely into both. I mean, whatever the situation. To the best of my learning, and again, there is no right and wrong and things can be debated along in financial world, but what has been time proven and where I've seen very consistent success is the fact that you have to bucket your capital into 1 year capital, 2 year capital, 3 year capital, and anything which is beyond 3 year capital truly becomes a growth capital and should go into equity as an asset class, or if you want to just mute the risk of equity, something like an hybrid would go. Don't try to create liquidity in the first year. The only option that you have to create liquidity in the first year is only around 2 kind of or 3 kind of product strategies that are available, and it has to be debt invariably. You keep the money in liquid and create a systematic withdrawal plan. His house is being taken care of with whatever money is required, and rest of the money is growing. That's one way. today there are a lot of bonds which do a monthly or a quarterly cash flow, though that's a very structured play, or something like what performing credit also does, where or revenue-based financing also does, which has a structural cash flow out on a quarterly basis. Those are very, very well-tailored solutions to look at, but one has to really understand whether the client has the risk appetite to take the credit play. That's one part of it. As the time progresses, you can keep increasing the equity allocation. Believe me, in a 5-year outlook, if you look at and you blend the performing credit to normal debt to equity, it is very reasonable to look at almost 12% aggregated return. Out of that, if you are taking 5 to 7% out as cash flow, then you are actually leaving the client with a deposit return, which is roughly around 5 to 7% on a pre-tax basis, what historically FDs offer on a 10-year period, for his capital to grow. Luckily, if you have a kind of a run-up that we have seen in 3 years, it will blow up very well. If it is not, at least the debt component will not make him jittery about the cash flows, which are very essential at the end of the day for him to run his household or whatever requirements that he has. That's what I said in the beginning also. Equity is great asset class, but it is not a short-term solution. It doesn't provide short-term solution to anybody. It is a medium to long-term asset class. And the probability of going wrong in equity is extremely high the moment we try to be over smart and overconfident about it, and we look at it as a short-term play.
Good evening to all. Myself Sanjay Jain from Jodhpur, Rajasthan. My question to all of you. Actually, every time when I go for the market outlook or any type of that program, and I want to hear the crux or the truth, but most of the time you have the only puppet language that in the shorter term the market look risky, and in the longer term it's good. So my question is that what is the longer term? The definition of that longer term, because okay, as far as the this question is been concerned, and we want to listen from you from the that top level the fact, but most of the time you give this diplomatic answer that we are capable because we are in the field, we are the marketing person. So that answer we know. So we want to hear that we don't know. But most of the same question, same answer we got from you. So I expect some new answer from your side.
So I think very valid question. बहुत बार fund managers से सुने तो ऐसा लगता है कि वो हमेशा ही bullish हैं, हमेशा ही बोल रहे हैं कि equity में डालिए. But broadly, when we say long term, we really mean 3 year. We don't even mean 1 year. We mean 3 year because 1 year, 6 months, 1 year में भी बहुत सारे known unknowns हो सकते हैं, unknown unknowns हो सकते हैं, as he rightly mentioned. कुछ चीज़ें पता हैं, कहीं suddenly यूक्रेन रशिया वॉर हुआ, वो किसी को नहीं मालूम था. Nobody could have told you that. कोविड किसी को नहीं मालूम. तो जो आपका surplus capital है, that only you should put in equities from a long term perspective. जैसा question अभी दिनेश जी ने पूछा, उससे भी यही interpretation मेरा ये था कि people have forgotten what are the risks with equity in the last 2 years. सबको पैसा बन रहा है, थोड़ा करेक्शन आता है, वो करेक्शन बहुत जल्दी चला जाता है, इसलिए सबको लगता है कि करेक्शन आया तो वापस डालो, तो वापस कुछ रिस्क नहीं है. That is not the case. If you actually have financial objectives, 6 महीने में 1 साल में कहीं पैसा डालना है, then you should be very careful with equity. Only if you have surplus capital, जो कहीं के लिए नहीं चाहिए. See, equity क्या है? Equity is eventually will mirror the growth rate in the economy, right? आप कोई भी asset class लें, it will eventually it's a function of growth. India का अगर broadly, if you look at how India is progressing, 130 crore people, the way India is positioned, normally you will get like 5-6% GDP growth and 10-11% nominal GDP growth. Accordingly, जो listed universe है, वो आपको long period of time, even with corrections and all, 14%, 13-14% देता है, और ये last 20-30 सालों में हुआ है. अगर आपने लीमन ब्रदर्स के क्रैश में डाला हो, कोविड के टाइम पे डाला हो, लॉन्ग टर्म 13-14 मिलता है. बट व्हेन आई से लॉन्ग टर्म इट रियली इज 3 years. आई डोंट मीन कि एक साल में भी कोई रिस्क नहीं है और 13-14% अश्योर्ड है. कोई फंड मैनेजर आपको लिख के नहीं दे सकता इक्विटीज में.
I would also like to add one point here on behalf of everyone on the panel. If 10% correction or 15% correction or 20% correction gives you or your investors sleepless night, equity is not the place. I repeat, if 10%, 15%, 20% correction gives you sleepless nights to you or your investors, equity is not the place. Because every year, there have been stocks which have corrected 20%, there has market which has corrected 10-15% from its peak, and it bounces back. In the long run, yes. So as she said, long term really means 3-year plus. Don't put or punt your money for short term requirements into equity, because last 6 months, 1 year, market has given fantastic returns. That's rear view mirror driving. We don't do that, especially with equities. I hope that answers for everyone. Yes, Sandeep. This will be the last question because we have a next session after this. So yes, Sandeep.
Yeah, hi, my name is Sandeep. Thank you so much, guys. Yeah, so if I listen any one of you in isolation, let's consider for private equity or debt fund or any of the in isolation, and you speak directly to me and I only listen to you in that preview, so I will be having biased decision that I will be only investing in the private equity or venture capitalist or debt or equity, right? How a customer in a consolidation manner should listen to you so that he can take a wise decision so that his portfolio is growing, keeping the risk management intact so that his goals and has to be met. So in the longer run.
Sir, listen to us only then.
Yeah. So not listen. Yeah. But let's consider ki because when we promote any kind of product in the market, we also do the same. If I am a mutual fund distributor, I will be always talking about at least 80% has to go in mutual fund or real estate or maybe that in debt fund or laws. But if I listen to you in isolation, I am getting the biased decision. But if I am listening to you as a panel discussion, we will be taking the broader to construct a portfolio. So what a intelligent investor should do or a normal person has to be doing in that situation? Anybody would like throw light on that? Yeah. Thank you.
As I said, you have to listen to us. I mean, our entire role that we have at Centricity is not only to bring in the products for you. We have democratized the product accessibility. We are unbiased towards asset managers. One thing we are very clear as a business, we will never get into the business of asset management because there are experts who can do this job better than us. So whenever you are into this kind of a situation, that is where our actual role comes, where you can connect with your people and this entire team that we have showed. Whenever you are in a situation, bounce off these queries to us and we will try to possibly give you the best logical solution. There is no right or wrong solution because we don't know what is going to happen in future. We will try to give you the best possible solution because unfortunately, the truth of the market is that, and that's how wealth management industry has evolved, people do not even, are not even aware of 70% of the options or the product ideas which are available in the market. It's a very unfortunate thing. People are not even aware. I mean, a very common thing which I always talk about, and I feel that the wealth management industry as a whole is really struggling, that today, any one of you can pick up the phone and can buy anything which is there in this room. Lights, water bottle, watch, shoes, everything. You cannot buy a financial product. All, barring mutual fund, you cannot buy. Stocks you can buy. So that's the technology slackness. But having said that, that is the role that we play whenever you have this kind of a situation, because there is no perfect answer and there is a human bias that comes. A fund manager comes or somebody like us comes, gives a great pep talk about the product. Human biasness tends to come in. But there is no one size that fits all. There has to be a customized structuring of the portfolio. And For doing that to the best of your ability, you need to know the maximum number of options and which are the ones which will best serve the objective with which you want to design a portfolio.
So, yeah.
Sorry, just to add to what he's saying. See, if I give you a parlance in the pharma industry, हम तीनों दवाई बनाने वाले हैं. एक मैंने equity का बनाया, इन्होंने debt का बनाया, इन्होंने credit का बनाया. दवाई आपको डॉक्टर लिख के ही देंगे. Because आपका क्या एनालिसिस है, आपका क्या रिस्क एपेटाइट है. किसी को 10% का करेक्शन चलता है, किसी को 30% का भी चलता है, किसी का फाइनेंशियल गोल कुछ है. सो वी आर मैन्युफैक्चरर्स, बट एक्चुअल goal based and risk based, that only the doctors can help you.
So with that, as Manu said, there is no one size which fits all. That is something which you should understand. And उसी के लिए सेंट्रिसिटी आपको और हमारे जो येलो टी शर्ट्स वाले हैं उनको ट्रेन किया है कि आप लोग इधर उनको या अदरवाइज जो ब्लू टी शर्ट्स वाले हैं वो आपकी खिदमत के लिए हमेशा हाजिर हैं. You talk to us and we will try to talk it out and give the best possible solution for that particular client or that particular situation. So with that,
Sir, मेरा एक क्वेश्चन है. या माय नेम इज़ निखिल, आई एम फ्रॉम आगरा. मेरा गीतिका मैडम से क्वेश्चन है थोड़ा पीएमएस को लेकर. मैम, आप लोगों की आईसीआईसीआई की टीम इस टाइम पीएमएस को लेकर बहुत एग्रेसिव है सेलिंग करने में, और वो कहते हैं कि म्यूचुअल फंड्स के क्लाइंट्स को अब आप पीएमएस दो, पाइप दो, कॉन्ट्रा दो, जो भी स्ट्रेटेजी देनी है. बट अभी हम लोग का कॉन्फिडेंस नहीं बनता अभी भी पीएमएस देने में, डर बहुत लगता है. तो कितना पेनफुल हो सकता है पीएमएस देना, और कितना बेनिफिट एक्स्ट्रा बना सकते हैं म्यूचुअल फंड्स के अगेंस्ट में, ये अभी तक हम लोग को क्लैरिटी नहीं हो पाई है. बट बैंकर्स ईजिली पीएमएस बेच पाते हैं एज कम्पेयर टू अस. तो क्या इसमें हमें देखना चाहिए कि पीएमएस किसको देना चाहिए, किसको नहीं देना चाहिए, और कितना पेनफुल हो सकता है कि अगर पीएमएस का गलत दाव लगा तो म्यूचुअल फंड से भी वर्स्ट रिटर्न्स हो सकते हैं. थोड़ा इस पे क्लैरिटी दीजिए मैम.
It's a very difficult question, and what we say is it's not mutual fund या PMS AIF. जो PMS AIF में पैसा लगाता है वो म्यूचुअल फंड इन्वेस्टर ही है. फर्स्ट यू हैव टू बी okay with equity as an investment. उसके अंदर if you already have money in mutual fund, then investors put their money in PMS AIF. Typically आप देखेंगे कोई भी investor directly debt से या fixed deposit से PMS AIF में graduate नहीं करता है. So the returns are better, but portfolios is slightly more aggressive. I cannot answer that question. It's again based on the profile of the customers. किसका कितना risk appetite है, क्योंकि portfolios are more concentrated when it comes to PMS AIF as compared to mutual funds. So, I mean, so for example, PIPE is, as you were asking, is a small and mid cap portfolio. Again, it will obviously be more, aggressive as compared to a multi cap or a large cap portfolio. But it goes back to your customer. 60 years का customer है, 20 years का customer है, किसका कितना risk appetite है. Accordingly, you can give.
So you can discuss with our panel as well as with our team, yellow or blue, whatever your choices, post this session. Probably we'll have to wind it up here because we have a next session and speaker coming up. Thank you so much, Geetika, Vineet and Harshal. Beautiful insights. It was a great session, and I hope all of us really, gained from it. And they'll be around with us, and we can interact over, tea, coffee, or dinner later on. Over to you.
Yes, thank you so much. Can we have a big round of applause for our very engaging panel discussion? Our panelists, and speakers, thank you so much. And a lovely lady also part of the discussion. Thank you so much. On that note, I would request Mr. Manu to kindly felicitate our speakers and give them a token of appreciation.
Auditorium, please don't leave the auditorium. We are starting with the next session immediately now. So please be here. Thank you.
I would request everyone to kindly give all the speakers a big round of applause, including the moderators, for carrying on such an engaging discussion. Our panelists, Mr. Vineet Sukumar, Ms. Geetika Gupta, and Mr. Harshal Joshi. Thank you so much for joining us for this discussion. And thank you to our moderators, Mr. Faraz and Mr. Anirudh, for doing the needful. Thank you.